welcome back to FreightWaves Today, the Freightonomics version of it. I am joined now by DJ Donahue, lead economist here at Sonar FreightWaves. And we had a whole bunch of economic releases this week. And DJ, we're going to sort through those. You know, we had GDP, PCE. I think for me to summarize this and put it in a neat bow is we're really trying to get to the point where we can figure out what's going on with demand side conditions in this economy. You know, we've got budgets coming up. We're going to have Ben Peterson come on in the second half of this show, and we're going to talk about shipper strategy. But to set the table, I mean, when I'm having my conversations with a lot of the people in the shipping community, they don't have a lot of confidence in their demand side forecasts, and they don't all have economics degrees.
I don't think you're going to need one to really see what's going on here, because between GDP coming through, between PCE, you're starting to see a big demand side story come through.
Yeah.
You're starting to see, when you look at PCE, and we'll get into the finer points of it soon, but you're starting to see demand side possibly softening and costs keep going up, which is going to hit not just the suppliers, the shippers, and the carriers, but it's also hitting their consumers too.
Yeah.
So you've got prices. We had Case Shiller come out. Home prices are going up more in cities than in the country more broadly. But again, we'll talk more about that. But we're seeing lots of stuff happening across the market. And yesterday was a huge release.
Yeah, no, for sure on that. So, I mean, I think, you know, I did the market update for Sonar earlier. I think it's a good thing to go ahead and put out there for this segment of the show. For those of you that watch this hour, I think throwing out to the Sonar update here to give everybody a little bit of a tone setter about what's going on in the transportation market. And then after that, we will progress into the economic discussion. All right, welcome to this Thursday's Sonar update. Looking at the tender rejection indices, we are not seeing a whole lot of movement right now from the Sonar Tender Rejection Index. Of course, the percentage of loads being rejected by a carrier to their shipper partners. 13.5%-ish is still a fairly high figure, though. So we've seen this acceleration in decline in July that has now come to a halt. We primarily think that is a derivative of modal shifting that has occurred. We see a lot of shippers using intermodal, not just as moving storage, but also since that transit time is a little bit slower than trucks. It's July, August, not a lot of sense of urgency on that freight right now. So that seems to have really not made as much of an impact in the last couple of days. So what we're thinking is that this is potentially a bottom for the moment. The next seasonal flooring, or the next part of the, time of the year that we see rejection rates fall seasonally, is around October. We're heading into Labor Day, so these rejection rates actually will probably percolate a little bit. If you look at the last couple of years, it's almost a foregone conclusion. Rejection rates are going to increase. The question is, how much are they going to increase? And I think it'll be a little bit stronger than we've seen in the last 3 years, because there's not as much capacity, a little bit of a sense of urgency growth there as we approach Labor Day as well. But for the time being, 13.5%, still very tight market. Probably a little bit ahead of schedule in terms of moving towards that equilibrium point of 7-ish% that we think the market really starts to see a lot more maintenance in terms of the capacity stays online and rates don't inflate as much. So we've got a long ways to go, and we probably won't get there this year. So moving into the demand side of the equation, just to put this into perspective, we talk about this being a supply-led cycle shift. And it matters in the sense that supply moves much slower than demand. It's also a lot less volatile. It's really hard to go recruit drivers, buy trucks, make trucks, get the trailers, put them on the road. That takes a long time. With demand, it's any and all commodities that can grow overnight. Consumers can show up, start spending money as they want. So this supply side cycle is really well illustrated in the accepted volume index compared to the Sonar Tender Rejection Index. Accepted volume index measures the number of accepted loads. So this is freight that carriers are accepting and moving. So guaranteed to move on the road. Then you have the rejection rate here that's going to tell you exactly how much of that is not being moving on the road. So we've got this accepted volume index. You can see over the last 5 years, 5 years or so, accepted volumes are actually down compared to where they were, but rejection rates are up. That's how we know that this is a supply-led cycle. Demand is not jumping higher. Yeah, it increased a little bit during the spring and summer months, but it really never broached this 2024 threshold. So we know a lot of capacity came offline over the last couple of years, especially last year. You see accepted volumes really floored out late last year, but rejection rates then increased. All that capacity came offline because the market could not bear it, couldn't fund the capacity that was staying there. We know this in all the earnings reports that came out last year that were abysmal. A lot of carriers losing money. So that's why we saw that capacity contraction. And now we're starting to see, and of course, all the regulatory pressure also helping exacerbate that and accelerate it. So it's going to take a minute, is the point of all this, for capacity to grow and for us to see a meaningful end to this cycle. It's probably going to happen really slowly unless demand side conditions fall down quickly. That is the one thing that happened this summer is we saw volumes, and if I could squeeze in on that last part there, volumes dropped pretty quickly or faster than seasonally expected because a lot of that freight went over to intermodal and moved on the rails. So let's hit the headlines here with the rates because that's what most people like to look at. Looking at spot rate indexes for dry van in white, refrigerated in the bluish teal, and flatbed in purple. You can see dry van is falling relatively quick. Flatbed is also starting to kind of edge lower, even though we're still staying high. But refrigerated, humming along as seasonally expected. So if you are operating in the refrigerated space, you definitely need to pay attention to this. Looking at a quick map of dry van rates, we've got a mixed bag. I know rates overall are going down, but look at all these blue markets. Blue means rates are going up more than they're going down. So there is some increasing activity, of course, probably due to Labor Day. We look at the refrigerated map, a lot more blue on this map, looking at spot rates increasing through a large portion of the population outside of the southern tier here. And last but not least, the flatbed map, bit of a mixed bag as well, but still a good bit of blue. Oh man, so DJ, the freight market itself has found a little bit of a, stabilization, in terms of rejection rates. Shippers, if you don't look at tender data, if you're looking at rates, especially on the dry van side, you're probably thinking, oh, cyclical shift, we're starting to see this cycle ending already. And it's not that straightforward. I mean, it's just, we have these nuances. The shipping community has gotten a lot better at managing supply chains over the last couple of years, just because they've had to. And intermodal being a component of that modal shift, you've got slower transits on the rails by a couple of days. If you don't need the inventory right away, sometimes we call it rolling storage, where you put it in those containers. Trucks are the same thing to an extent, so you don't have to get taxed on that freight. But
yeah, but it's more expensive on the trucks because trucks cost more to run. Exactly.
Right now, that doesn't make any sense. But the intermodal hasn't changed. Like their costs have not increased meaningfully outside of some fuel pressure that's driven them up. And of course, later in the year, intermodal is expected to take some upper single-digit rate increases, I think, is the consensus in the community. Although, the data would suggest that they've got a little bit more room to go higher if they wanted to and still not risk losing share, which is, something that shippers are going to have to take into account if they have transitioned a lot of their freight over to the rails. Something I want to talk to Ben about a little bit later on. But let's dive into this economic data, because the main things that I want everybody watching the show to focus on is that we have this interest rate situation. For the purposes of combating inflation, which is the narrative, whether or not you agree with all the reasonings behind whether or not to raise interest rates, decrease interest rates, tariffs, no tariffs, all that noise, the one thing that is certain is that a lot of the community is very split on how the Fed is going to approach combating inflation moving forward. We've gotten no guidance on purpose and for right or wrong. So what does that mean for the shipping community? Well, if you're worried about demand forecasting, if you have higher interest rates, those CapEx spends are going to come down a little bit because that's inflationary to investment, which is kind of a conundrum if you're thinking about demand forecasting. So it's a mixed bag. So let's start off with GDP, DJ.
Sure.
What did we get this week with GDP? Quarter two, it was, of course, the revised
Yeah, this is the second release of the data. So you get 3 releases of data from BEA. You've got the advanced. This was the second. So they revised Q2 GDP up to 1.5% overall. And what we're seeing a lot of is the big movers in this are not investment or exports. In fact, government spending was down a little bit, which is not a common thing. But we saw increases in domestic consumer spending and decreases in imports. And imports are taken as a negative when it comes to GDP because GDP are final goods and services. It's the famous Bill Clinton, it's the economy, stupid equation. Great story, but we don't have enough time for that today. But anyway, imports are decreasing, consumer spending is up. And so we're seeing, as a net of that, real GDP increasing to 1.5% quarter over quarter. And so there's a lot of different ways to interpret this. If you want to take a high-level read on this and just look at the aggregation there, which aggregation can lose a lot of information, you could take this as a story being of love them or hate them, tariffs are doing what they're intended to do. You know, we are decreasing import consumption and we're increasing domestic spending. So that is one possible approach to this. I don't know that it is. Another possible story is that we could be seeing a Prime Day effect. One story I've heard is that because Amazon moved their Prime Day from July traditionally, which would make it Q3 spending as opposed to Q2. They moved it back to June for a number of reasons. One of them, I think, was the fact they wanted to take advantage of World Cup. But regardless, moving it back to Q2, we're seeing that increase in consumer spending. When it comes to GDP, it adds up a whole lot of things. So it could be tariffs are doing what they're intended. I'm not so sure of betting the farm on that one.
No, I like it. I think that a lot of economists' high reads are going to be that way. And I think, we've been monitoring this import impact on GDP for the last 2 years now. We've seen a lot of erratic behavior on the import side. We've had, shippers are like, well, oh my gosh, if we're going to get a 30% tariff, we're going to bring a bunch of stuff into the country earlier than expected. And what that's done is now these comps, these year-over-year comps, and even quarter-over-quarter comps to an extent, have become distorted because the traditional seasonality in terms of ordering patterns have been very dramatically shifted. If for those of you that watch Freightonomics, you guys know this, in terms of looking at the IOTI, when I pull that up, and I didn't load that for today's show, but the IOTI, of course, is a booking. So it's showing you import ordering behavior, not customs, but ordering behavior. And that's the point. We're trying to get to the earliest point where shipper behavior is measurable. And so when they're ordering a ton of stuff, we're seeing that very quickly. Now, it could take 15 days to get to the United States. It could take 45, depending on the routes and which point of origin and all that kind of stuff. That's neither here nor there. What we're looking at purely is ordering behavior, and that would suggest that last year was one of the most volatile ordering cycles we've ever seen. We had a huge pull forward event and also a recovery event in June last year, which of course is going to influence the year-over-year comps for this GDP. And it's been moderated this year. And I've talked to a lot of people about this in the sense that shippers, and Dr. Rogers, who again, friend of the show, has come on and said, like, shippers were trying to pull back from this just in case ordering process that they had last year because they were worried about tariffs, trade policy. They didn't know what was going to happen next. They were, of course, trying to manage costs. Well, warehousing costs have gone through the roof. And so you can't just necessarily order a bunch of stuff and throw it into a warehouse and save money anymore. So there's a lot of things going on there. So this year, what we're seeing in the data, IOTI is more, it's flatter. It's elevated-ish compared to, say, a 2023 environment where they were really drawing down inventory levels and they were not. Now it's showing more of a flat-ish plateauing, and we're starting to see that edge away in August. They're not ordering as much in August as they did in June and July, but it's really elongated this, what we would call a traditional peak cycle. So when you talk about imports inside of GDP, we almost actually, a lot of the people on the show last year, we were like, you know what? Because of imports alone and their lack of comparability to previous years, we're going to throw out GDP until this noise kind of resets. And I think we're right now going into a period of reset.
So the argument is that what we're seeing now in the drop in imports is less an actual policy impact and more of an accounting trick, a counterbalancing of the noise that was
exactly
an early reaction to the tariff policy as opposed to actual impact of tariff policy now.
Exactly. So you've got this adaptation. And since GDP is a quarterly figure, it takes a long time to smooth out the noise and transition to a period of stability. And of course, you're an economist. A lot of economists have figured out since COVID, really, that we really have trouble when multiple variables change their relationships at the same time. We have trouble reconciling and getting back to a point of understanding. And I think GDP is probably one of the more exposed because of the import behavior. So let's go on to PCE, because I think this is going to be the one that this audience needs to pay attention to the most. GDP is interesting, but it's in arrears and it's over. I'm the type of person that moves on. It's nice to know what happened, but I need to get the next step. And PCE has an influence in that inflation discussion that the Fed is going to have. Probably one of the more contested Fed meetings coming up here in the next month. This reading, first of all, tell us about it and your takeaways.
So we saw PCEs remain relatively flat. It went down a little bit. We came in at to overall PCE, which is personal consumption expenditures price index, came in at 3.6%. And so we were, of that, the core index was about 3.3%. Now, that's important for a couple reasons. First off, core is when you have all the products minus the really volatile ones, namely food and energy. And so since there was only a 0.4% impact of energy and food, what that tells us is that most of the inflation we're seeing on the personal consumption expenditure side is coming not from food and energy, which is kind of surprising. We would expect to have a greater impact with what we've been seeing with oil prices, with diesel prices, which we'll talk about here in a minute, as well as seeing what's been coming out of the Middle East because of those.
Right.
Or, excuse me, the Middle East causing the volatility in oil prices. So we honestly, I think, would have anticipated a greater impact of oil and food on overall inflation, but apparently it's not. It's all the other stuff that we purchase.
Yeah, it's funny too, because it's hard to measure this, because I can also see this purely from a transportation perspective. When they talk about inflation, it's hard to say that a finalized good is inflating because of a thing, because there's all sorts of stuff that influences that upstream cost, that cost of goods, because you could be looking at a component of a component.
Yes.
And everybody uses transportation. There's nothing that's not exposed to transportation. And so when we talk about the price of oil and diesel, all that going up, it may not be directly measured in that inflation. Like, it's directly measured in the inflation figures that we look at, but it's also not necessarily broken out as a cost component of some of the production that we see. So it's an indirect influence on inflation and a lot of upstream behavior. And that's really hard for us to see in some of these things. But I think
Leonard Reed would agree with you.
Yeah, but I mean, I think to your point, like, it is shocking at how minimal, the inflation is having on, or the impact is having on energy and food. So my question to you is, as put yourself in the Fed chair's position. Like, this is still above the 2% target, which another time, another place, we can debate whether or not that's reasonable. But I think at this point, we all accept that the 2% target is something that even Kevin Warsh has come out and said, hey, that's a target. I'm going to stick to it somehow, some way. What do you think this means moving forward for this meeting in terms of raising or holding interest rates steady? Well,
when it comes to the Federal Reserve, monetary policy is their thing. And so affecting the amount of money supply is how we're going to go out. I mean, when you look at inflation, it's a primary component of two things. How much money do you have and how much stuff do you have?
Right.
And the Fed cannot really directly impact how much stuff that you produce as a country.
Right.
So they're going to probably impact the amount of money that we have in the economy. That means that they're going to probably shrink the money supply through bond purchases, and that's going to lead to higher rates. Because if you want to bring down inflation, you need to pull down that top level of the fraction, which means reducing the money supply, which means increasing interest rates as a secondary or a direct effect. So that's going to have a lot of impacts, particularly for our customers, because when you have a higher interest rate, it means that your CapEx is going to be hard to come by, your credit is hard to get as a business. It means that your customers, because the interest rate doesn't just affect businesses, it also affects direct consumers and their ability to get credit. It means that you're not going to be able to get as much Christmas presents as you might otherwise, because it's going to be more expensive to borrow money.
Right. So put that in the context of the recent buyback.
Oh, the recent buyback. That's a whole mess.
Yeah.
When it comes to the recent buyback, I've got a lot of thoughts about it. Specifically,
Try to sum it up, and you got 2.5 minutes.
I got 2.5 minutes. Okay, so we've got the Federal Reserve issues bonds. U.S. Treasury Secretary Bessent has announced that he's going to increase buybacks. We're going to be talking, and what he's essentially trying to do is use the Treasury Department to try to put pressure on reducing inflation. Now, the way he's doing that is by as I understand it, increasing buybacks, and he's kind of making a bet on the bond market. He's betting that if he goes for more bonds, it's going to, and he's also going for shorter term bonds as opposed to longer, such that he's going to want to hope that rates are going to be lower in the future.
Right.
The reason that is so important is because right now, the servicing of the debt, what the interest that the federal government pays on the debt that it has accrued, is now outstripping national defense spending.
Wow.
Yeah. So because of the higher interest rates we've been seeing, the Treasury wants to do everything it can to try and keep rates down so that it doesn't spend so much on interest. It's using the bond market to try and do that, to try and I hate to say it, but try and beat the market. It's very, very difficult to do that, though. And so what's going to happen is that as they start to change their bond buyback purchasing system, or the manner in which they purchase bonds, they're going to try and make a bet that rates are going to go down in the future. Because if they lock in a higher rate now, that means that you pay that much more as time goes on. Because once you get a 30-year bond, you're locked in at that rate. There's nothing you can do about it until it matures.
So what does this mean for people that are looking at, the bond market volatility? Obviously, it came down and then it went back up in terms of the long tail. Like, does this feel like a reason to kind of make the argument against raising interest rates? Or
I think that Kevin Warsh has a very, very narrow and difficult wire to walk, because on one hand, he's got the financial stability. I mean, the Fed has a dual mandate: keep employment high and keep prices stable. Keeping prices stable is what ties into that inflation number, and he wants to try and get to that 2% year-over-year rate.
Right.
In order to do that, he's got to raise interest rates, which is going to decrease the money supply, which is going to bring down the prices. But if you raise interest, what's going to happen is that the federal government's going to have to pay that much more to service the debt. Because what people understand, the debt is not just a solid number. It is a series of bonds and Treasury securities that the Fed will continuously roll over based on when the old ones come due, and they have to basically, to put it in terms our customers might understand, they have to bring out a new credit card to pay off the old one.
Right. Whew. Well, that's a lot of stuff. So we were going to go to a quick break. When we return, we're going to close a little bit of this economic discussion and bring on Ben Peterson. Stay tuned for more. Back to Freightonomics in the second half of this show. So first things first, I want to close the economic gap here with DJ. We're going to cover durable goods orders, then I'm going to bring on Ben Peterson and talk about the rest of the year from the shipping community's perspective. So DJ, the last thing I want to talk about with you is this durable goods orders. July was a 1.1% versus a 0.5% estimate, and June was revised upwards. So this looks like durable goods economy is actually doing okay.
It's doing okay. It's not a huge movement.
Right.
I think that one of the things we really need to keep in perspective is that, and you can see on the screen, that we had really, really big movements in April and May of this year, a big upswing and a big drop. So
A little bit of cost averaging there to try to make
I think that we're kind of moving back to the small movements, kind of normal. We saw like last October, November, similar jumps, but not quite to the same magnitude. So I think we're kind of stabilizing and kind of playing close to the chest on this point. We're not seeing huge movements, but we've had 2 months of growth, so it's not a bad thing.
Yeah, I mean, how much do you put into this figure, by the way? Because durable goods, of course, are the things that obviously move on trucks and on the rails and move freight, and they tend to be a pretty good predictor of future freight movements. What's your read here on the second half of the year that we're kind of already a couple of months deep into?
We could see some increases, but I'm not putting a whole lot of faith.
Not overly bullish.
Yeah, I'm not really super bullish. I think we're going to see some increase or at least something stable. But since we're not seeing because I mean, if you look August last year, durable goods were up 3%. Now we're half that.
Yeah.
So I wouldn't say bearish, but I'm not strong bullish. How about that?
Yeah, no, I think this fits in with a narrative that a lot of people are very conservatively ordering. And it's, again, I think when you put it into the context of how people were expecting us to see an economic downturn a lot of the last year or so, and it's really never manifested. I mean, the manufacturing sector has been the big surprise, I think, for a lot of people. And as much of that as you want to apply to the data center build out, I think is a thing, as well as the energy build out that goes along with that, I think is something to keep in mind and parse that out. But I still think, based on consumer, take the sentiment out of I think the sentiment has really not been well connected to economic output from the consumer side. Am I right in saying that?
I think so. And when it comes to, I mean, because obviously I wrote an article on the FreightWaves blog about the the sentiment and the measurements that are going into the data center build out. So if anybody wants to read that, it's on the the Sonar freight market blog. There, got it out. Yeah. But as far as the data center build out connecting to the consumer market, I mean, we're seeing the boosted manufacturing. We're starting to see a lot of backlash on the political side of it, but I don't think that it's really necessarily economically driven. I think it's more politically and emotionally driven than anything. Right,
and that makes it really hard to read the feelings. I mean, for people that have watched me on Freightonomics for the last 5 years, my feelings on feelings indices, they tend to be...
I think, and I also think that people aren't really understanding what they are. They see these giant hyperscalers, they're big, they're loud, they supposedly draw a lot of energy, but I don't think that they understand what's actually, what they're doing, that they don't see the Rosie the robot underneath the hood, so to speak.
Right. Well, DJ, thank you so much for breaking that down. We'll, of course, be back next week to go into further. We didn't get to cover everything, but as typical, that's going to be the case. So before we get to Ben, I want to call out a couple of reads for our audience. And the first story that I think people need to be mindful of for this audience is clearly the Panama Canal. The new capacity cuts puts U.S. ports on notice. This is a big deal because it's going to reduce the amount of freight that can come through the Panama Canal. Certainly it'll slow down the transit. We saw this a few years ago in 2023. Towards the end of the year, we saw Savannah volumes drop because some of these larger Neo-Panamax boats could not get through the canal. And of course, they're trying to save some water for the dry season, which comes up and runs throughout the winter down there. And of course, they're seeing this dry season, extend. It's actually started way earlier than expected. If I want to pull up the FBXD here, which is going to be the Freightos Baltic Exchange indices, if you look at rates, and this is an ongoing debate in the community about how much capacity, how much supply and demand actually makes a difference here. Demand side indicators do not support rate levels to this size. We don't have a lot of visibility into the supply side dynamics, which of course you heard Malcolm and I discuss earlier about one of the stories that I also want you guys to check out is the story around building 40% more fleet, basically growing global container ship capacity by 40% over the next couple of years. That feels like it's going to be deflationary on rates for transit. But at this point, we've been talking about the growth in shipping capacity for the last 4 to 5 years since COVID, and we're still seeing rates almost at COVID levels. So it's really hard for us to parse this market apart. So it's going to be an ongoing thing to where you have to pay attention as an importer. And of course, Ben's going to talk about what he thinks about some of this here in a minute. The next story I think that you should check out, this is probably going to be one of the last times, Craig and John talked about this the other day on FreightWaves Today, but the BMO credit report that came out basically shows what we all expect it to show to an extent, that we're seeing a lower level of distress in the lending to carriers. And I will say this, from my perspective, I thought it would be lower. The questions I get a lot in the space are, how are there carriers out there that are still not doing well? If you've been paying attention, you've got Pam, a well-respected carrier, very exposed to the automotive side of things, operating at a 110, which means that they were losing 10 cents on every dollar they spent to haul freight in Q2. So just because you have a couple of months of elevated spot rate activity, contract rates do not increase overnight. So you're still hauling a lot of freight. Spot market volume represents roughly somewhere between 15 to 30%, depending on the market conditions, of the total freight volume that's available out there. So these guys have years of distress going on. Has it improved? Absolutely. Is it going away overnight? It is not going away overnight. And so I think that's a one big call out to watch there. So without further ado, let's press on because we need to get Ben Peterson's take. He is our shipper market expert, for lack of a better term, but head of shipper solutions, I think is your technical title, is it not, Ben? Bring him on and have him give his perspective here.
Yeah, head of shipper solutions. So keeping a close eye on what's going on, and obviously we're on the cusp of bid season, so there's a lot of things happening right now.
Yeah, Ben. So I want to dive right into it because we only got less than 20 minutes to break this down. First of all, I want to get your quick read on some of the issues that you are encountering from some of the customers that you're talking to working for Sonar.
I think the main issues right now is the uncertainty, right? There's a lot of uncertainty, probably now more so than definitely the last year, the last 2-3 years for sure. We've seen a little bit of downtick in rejections and some of the cool off. And I think everyone has to be cautious of that because I think more or less we're seeing some stabilization now. If we look at the Sonar PPI, it stayed relatively flat for the first time since we've kind of switched to the quantitative methodology. And so I think that's more of a sign that this is more of a normalization, and rejections are still up above 10%. So you would still consider them tight. And so I think we're going to see a very tight environment heading into bid season. Mm-hmm. And so from a shipper standpoint, it's how do I approach this? How do I need to be strategic? What do I need to prepare myself for? And when I think about my bid, I need to think about my budget and what type of assumptions should I be making as I approach those budget conversations.
Yeah, budget season, of course, a huge deal. I used to be in FP&A from a carrier perspective, and it was nightmarish. So from a shipper perspective, you have a lot more moving parts to deal with externally. So, you talked about uncertainty, and I feel like that's the case with both the demand forecasting perspective, which of course influences revenue, but how do you get that? How do you ensure that you have enough inventory? If demand, you certainly don't want to have too little inventory and miss out on potential revenue, correct?
Correct, yes.
So how do you manage through this a little bit when you're sitting there? I mean, and again, a large part of the community that I talk to is concerned about the consumer showing up in the second half of the year. Just talked to DJ, talked about how there's some risks involved in the second half of the year on the consumer side. If we do see rate increases, that is supposed to definitively decrease demand, which would influence some of these shipper forecasts moving forward from a revenue perspective. It looks like they really don't want to increase rates from the vibe that we're getting from that side of the table. But what would your suggestion be, removing demand from the forecasting component for now? What would some of your strategies be trying to set yourself up to make sure that you have inventory available if you need it there and you might have under-ordered a little bit?
Yeah, essentially you need to have a fallback plan, right? You need to have those contingency plans in place in the event, we don't want to talk about demand, but that's going to be a driver of it, as you need to be able to have a lever to pull in the event that it is needed. And right now demand has been somewhat low, but I think that would send things into another phase, especially from a transportation market standpoint. If that was to uptick, we've talked about this, a ton in the last couple of months, that everything that's happened has been purely capacity driven.
Right.
If you were to add demand on top of that, then everything, I would say, increases significantly from, a stress on the shippers' networks and being able to supplement that in a fast fashion. Not only is there increasing inventory needs, but there's capacity needs to support where that inventory is ultimately coming from. And so I think when you talk about building contingency plans, there's a lot of pieces that you need to make sure are in place in the event you need to flip that switch and react to what's happening in the environment.
Yeah, I mean, and we've been talking about this on, obviously on FreightWaves today. I've written about it several times in the chart of the week on FreightWaves.com. The modal shifting component, which I think a lot of shippers have utilized intermodal more, especially this summer. We've seen a reacceleration in growth of intermodal use. J.B. Hunt's earnings, of course, recorded this exquisitely well. But the also LTL, I came from LTL, and I'd always get a little bit aggravated when we would get these large chunks of shipments that we weren't expecting to get. It would really be disruptive to the networks, but it's a shipper maneuver because LTL networks, of course, are guaranteed capacity. A dangerous game to kind of play, in my opinion, for a long period of time. I think it's clearly a temporary maneuver. But what would you say to some of these shippers who have been either, if they haven't been leveraging intermodal, or if they are, what are some of the thoughts that you have around this modal conversion and shifting strategy moving through the rest of the year?
I think it's something that needs to be highly considered by, the shippers that have the volume and the opportunity to potentially look at, utilizing intermodal. I think the LTL side of thing is more of a fallback solution. I think there's probably parts where it fits in and makes sense, but not to the tune of what truckload to intermodal does. Mm-hmm. And as this is a little bit of plug with the Daily Watch coming out tomorrow, I was looking at it, and I think right now at a national level, the intermodal savings spread compared to truckload is like 33%. So there's cost savings there, right? And I think when you talk about the available capacity, you don't have the constraints with intermodal that you do with truckload. And we're seeing right now from a loaded rail car volume, and we're at 5-year highs. And so there's signs pointing to intermodal being a sign of relief for truckload and some of the challenges we're seeing on the truckload space. Now there's a lot of details behind that. You can't basically look at and say, hey, I want to go intermodal. That's going to be as simplistic as moving a truck. It's not, and not to say that moving a truck is simplistic, but there are different variables included to make that happen. But I think it's an option. And I think intermodal conversion is always the priority is cost savings. It generally is cheaper to move a shipment via intermodal versus truckload. But there's also a service component to it too, or a capacity component as well. There's, different strategic ways you could approach it where you might have a high volume lane and have risk of being able to support that lane over the road. So maybe you ship 30% of it, 40% intermodal, and then the rest you ship truckload. But I think thinking through different scenarios in that way as you approach the bid season, and especially 2027, because there's going to be creative solutions needed to manage the type of transportation market we're in.
Yeah. So for those that have started using intermodal, I've been kind of touting this like, well, if everybody does it, we kind of see this herd mentality. It's like, duh, when you have a 33% savings rate, you have to consider it. But there's an inherent risk, just like anything that you do when you're starting to save money and cost. Like if everyone jumps to it, the market is going to address this in some form or fashion. And there's this level of disparity in the solution. I just, too good to be true starts flashing in my head. And we know that rates are coming up for the intermodal space. We know that this rail merger situation for the transcontinental stuff, they're trying to avoid raising red flags. So it's, to me, I would want to think about, okay, what's the risk of us with whatever we've converted to intermodal? Is there an inherent risk for, a spike in cost later in the year? We haven't seen anything about peak season surcharges because the peak season really doesn't, I don't know that you really can say there's a peak season anymore on any level from the maritime and intermodal side, because the data suggests that it's been a very wild ride here in the last few years. What would you suggest shippers be mindful of for some of this modal conversion risk?
Yeah, I think when I would think through approaching it, it's those that have established intermodal presence already is probably where it should be most of a priority. And I think through, maybe in the past you've evaluated some lanes and have had pushback from the customer team because the transit times didn't make sense, or there was, restrictions with getting the product from execution to actually the customer in a timely fashion. But when the market's turned like it is, when you're going to see probably some inflation on those lanes from a truckload cost standpoint, I think external teams are more open to some of the different ways that you could approach, not only cost savings, but different service to ultimately meet the customer's needs. And so I think as you get into more of a tight environment, you have the ability to bring those more creative solutions to light and probably get buy-in, because everyone's looking for solutions that, again, help cut costs, but still meet the demands of the customer. And so I think the intermodal conversions make sense for those that have the presence. For those that don't, again, you have to have the volume and kind of some of the infrastructure to have a seat at the table. But it's something that should be evaluated, because as we approach the new year, there's going to be solutions that need to be examined, because truckload could prove to be pretty challenging for some.
Yeah, I don't think I talked about it on the market update today. Rejection rate of 13.5% feels a lot better than a 17% rejection rate that we saw peak in the summer, but it's still not ideal. It's not an acceptable compliance rating. When you flip it on the other side, it's an 86% ish carrier compliance figure, which of course most shippers would be. Especially if we talked about this last year, what would I tell you if I gave you an 86% compliance rate at 40% higher cost? You'd be like, no, man, I'm not into that. But that's what happens with trucking, is when capacity tightens, you pay more for less because the market is disequilibriumed, or out of balance is a better way to put that. So one of the things, you and I talk about this a lot in terms of bid strategy. And of course, a lot of these shippers are going to reach out to us and ask, what do I need to do with my bid this year? What kind of expectations should I put around rate increases? And you and I both take the approach that we like to be very custom we like to look at the business itself. We like to see where your rates are at a lane level, where you're exposed, because one of the interesting components of this intermodal shift is that we've seen a lot of volume and usage growth on the eastern half of the United States, which is not as fungible with truckload, but the cost spreads are so high that it's making more sense. So a lot of these shippers are utilizing Atlanta, for instance. So if you're seeing, we're starting to see rejection rates really fall out of the Atlanta market over the last month or so. I think you or Thomas wrote about this recently in the Daily Watch, but it's one of the hottest markets in the country in the summer, and it's kind of come down off of a cliff there in terms of rejection rate. So from a shipper perspective, would you say, you really need to take a more granular approach to your strategy in terms of, one, forecasting your transportation costs this year, and is there a number that makes sense? And then two, of course, just making sure that you have some buffer in your budgets.
Yeah, there's a lot to unpack there. I think, so to start, I always promote granularity, right? You need to be able to drill down to the lane level when you're approaching your bid. And I'm always an advocate that you should never send 100% of your network out to a competitive environment. I think you open yourself up to increased cost exposure that you necessarily don't have to do if you approach it in a more strategic manner. Mm-hmm. And so a lot of that starts at, let's evaluate all of our lanes. And one of the main things there is, let's look at the market costs and understand, where are we up, where are we down? But with a lot of what we do, we layer on the market components to where rejection's trending, where's volume trending, where do we think that trend is going to last, and what does that ultimately mean based on what you're currently paying and what your current structure looks like, and then create recommendations based on that. I'm already getting a favorable rate from this incumbent. The network or the market dynamics are pretty challenging. So I think I'm going to just try to lock in this incumbent for another year or 2 years, because even if I get a 1% to 2% price increase, I avoid a potential 6% to 7% price increase. Things like that, approaching it in a more strategic manner. I think just talking about bid strategy in general, we kind of ended with this last time we talked about a month ago, but the transparency piece of it, again, is going to be a big component. I think as you approach bid season from a shipper standpoint, open communication with your carrier partners on what bid timelines look like, giving them windows in which to execute the bid, making sure your requirements are clear and they understand them. Because the one thing that shippers, they can't be naive about, and they need to think, is that carriers are in bid season as well, and they have multiple customer requests coming in, multiple pricing requests, and so need to understand that they need time to present the best possible solution. And so working together to make sure what that looks like, not just launching an RFP and hoping the best kind of solutions come back. So I think, again, I always push transparency, because that's key in this process.
Yeah, I mean, I think you probably have talked to a lot of people, just like I have in the space, that were able to just kind of take a blank page and say, yeah, 1%, I need a 5% decrease this year, I need a 4% decrease, and kind of just push it out there over the last 3 years and get away with it. And of course, when capacity gets tight, you can no longer do that. And you know, we know that there's a lot of churn in the industry around transportation management. You know, you got Bill from accounting that hops in one year, and he comes into an environment that's really easy to operate in, and he thinks this is the easiest job ever, and I'm just going to keep doing what I've always done. And all of a sudden, it's like, well, your carriers aren't showing up anymore. And you're like, well, what are you going to do about it? Well, there's no playbook for Bill because he hasn't seen it. And I think understanding that, you know, the market has been very cyclical and very volatile is interesting. And so we only have a couple of minutes left, but I want to get your take on the current trade policy environment. We just had another, you know, tariff threat on Canada. How would you approach this, and what are your thoughts on this, you know, as we enter, you know, I think it feels like more of the same, but also we do have a lot of presence or trade relationships with our neighbors to the north there.
Yeah, I think with trade policy and in general, it's just the world we live in right now, right? And from a shipper standpoint, inevitably, it's something that you're going to have to deal with. I think it's going back to the beginning of our conversation, it's contingency plans. And understanding what those impacts look like. I think if you're a shipper that operates in both the U.S. and Canada, intra-Canada, cross-border, what have you, you need to have an understanding of, you know, what does our internal plan look like in the event we shift production, or, you know, volume moves to a different space. And I think about it too when I was on the shipper side, because we did operate in both the U.S. and Canada, and what happens to my carrier's general network. So, you know, maybe from my shipper lens, we're not going to be directly impacted, but to a degree. But if I have another carrier that's got other shippers that are going to severely change the way that they service their network, that can indirectly impact me. And so I think it's about the full picture and understanding, you know, based on some of the recent developments and where we see that probably continuing to go into 2027, ultimately understanding how that could potentially impact your network.
So I know this is a little bit out of your, you know, your scope here, but put on your procurement hat. You know, you worked at General Mills for a while, as well as Target. So you've been around these people. What are you taking this tariff as something you need to change your procurement strategy on? Or are you just going to wade through it and let it pass like everything else has?
Usually, I mean, from my seat, the procurement team is the ones dealing with what decisions are made. So I'm building a network based on what I know, not what could happen. And right. So I'm monitoring them closely. Am I making award decisions based on stuff that's not actually put in place to happen? No. I think there's plans in the event something does change, how we execute that quickly. But I think we would more or less kind of sit and wait and monitor, but not act on it quite yet.
Yeah. Do you think they would sit on it? Or do you think they would try to figure something? I mean, you just said contingency. I just don't know how you manage contingency with a Canadian replacement.
Yeah, it's a good question. I know you don't. That's not in your background, but I just wanted to throw that one out there. Well, Ben, thank you so much. You, of course, write the PPI. People that subscribe to, you know, the Sonar light offering, Market Movers, can also see that. You know, check out the blogs too to find where that is. And of course, you write the Daily Watch, and I appreciate that, and the Weekly Outlook. So for sure, everybody be watching for Ben on all the social channels as well. And thanks again, man. Well,
That was our show for today. We will, of course, resume production next week. Approaching Labor Day, this market still looks like it has some gas left in it. So for sure, you're going to have to keep watching and stay tuned. Have a good week.